Hello, Smart Money Tree podcast listeners. Welcome to this week's show. My name is Kirk Chisholm, and I'll be your host. And today I'm joined with a good friend of mine, Stan, the Annuity Man Haithcock. How you doing, Stan?
I'm good. Drop the last name, Stan the Annuity Man. I am in the process of convincing my wife of 35 years to change our last name to the Annuity Man, and that would be my greatest sale of all time. We're close.
We're close. Really tough negotiation on that one.
Yeah, Christine the Annuity Man doesn't ring like Stan, but there's always trade-offs.
Hey, when they get married, sometimes they gotta take your last name. So that might you're a
I'm, I,
little too late on that one, I guess.
yeah, I'm glad to be here, and I'm glad to have the opportunity to tell the truth, the brutal facts about annuities, because it is the wild, wild west of myths, untruths, and misleading sales pitches and bad chicken dinner seminars. And as we talked before, the annuity industry has earned its bad reputation. Not to say that we're perfect, but we do tell the truth.
Well, that's good. That's good. Well, those of you longtime listeners will know we've had Stan on before, twice actually. We had him on in a debate as well as an interview, and always enjoy having him on. So, given that times have changed, the economy's changed, thought it was a good time to bring him back on. But for those of
Mhm.
you who have not listened to Stan before, and really sorry to hear that, but here's your chance. So, Stan, tell us a bit about your background, how you got into annuities, how you
Sure.
got started in this field.
Well, my background is with the major wirehouse firms. I started with Dean Witter, which then was purchased by Morgan Stanley. I was there for a while. Then I went to Payne Weber, and that was purchased by Union Bank of Switzerland, known as UBS. So I've been on that side of the ledger, which is the growth side, the market side, Wall Street. I worked in New York and other places. So I decided to leave that and just focus on contractual guarantees. My motto is you own an annuity for what it will do, not at what it might do. And annuities are contracts. So base your decision solely on the contractual guarantee. And what we've done at my site at theannuityman.com is allow you to run quotes using our proprietary calculators. You can run those quotes 24/7, 365, and no one will call you or show up at your doorstep. And I just think that's the way this should work. And everybody out there listening to me right now, and you, Kirk, right now, already owns an annuity. Please do not debate with me. It's called Social Security. It's the best inflation annuity on the planet. And if you have a pension with your employer, you own a second annuity. Annuities are transfer risk contracts that primarily solve for four things. The acronym that I've created is called PIL. P stands for principal protection, I stands for income for life, L stands for legacy, and the other L is long-term care, confinement care. If you don't need to solve contractually for one or more of those items in the PIL, you do not need an annuity. Never, ever, ever, ever buy an annuity for growth or potential returns.
It's funny you say that because that is usually the pitch. Oh, you can
Yep.
make lots of money in an annuity. And so why is that incorrect?
It's incorrect because there's not an annuity on the planet that pitches potential growth that can actually deliver it. Now, I can say that with confidence because I came from the street. I came from the other side, which was the Dean Witter, Payne Weber, Morgan Stanley, UBS. I understand that side of the ledger. When I came out here to become Stan the Annuity Man, and by the way, we are licensed in all 50 states, main office in Las Vegas, Nevada. Um, I was shocked by the sales pitches for growth. Most of the annuities out there for potential hypothetical theoretical growth, the annuity companies can change the rules at their discretion. I'm talking primarily about indexed annuities and things like that. Variable annuities were put on the planet in 1954, 1955 by TIAA for tax deferred growth. But the problem with those is number one, if you're buying a commercial variable annuity, the fees annually are very high. And if you buy no load variable annuities, the choices for your mutual funds, i.e., separate accounts, are very limited. So, keyword limited. If you want growth, if you want market growth, go buy non annuities. But you cannot have your cake and eat it too. There is no too good to be true product. And if it sounds too good to be true, it is, without exception with annuities. And that, unfortunately, is the sales pitches you will hear at that bad chicken dinner or expensive steak dinner seminar that you're getting those invitations to.
But those seminars are free, Stan. I mean,
Listen, if you're going to a steakhouse that you would never go on your own, then you have to factor in all of the commissions this person's making. The other thing too is when a person is standing up there selling the annuity, they're typically trying to sell one type. There are many different types of annuities, and the one type they're trying to sell is typically an indexed or a high commission, very complex annuity. It's like if a doctor held a seminar and was prescribing one drug to everyone in the room, you'd get up and walk out. It's the same principle.
Yeah, I mean, I hear this a lot when, we're talking to a prospective new client and they're talking to some commission, I call them commission bombers, but
They
uh,
are.
commission bombers, and they're like, "Oh, well, it doesn't cost me anything to do this."
Mm.
Uh, I mean,
Let's
somehow,
talk about that. Let's
yeah,
talk
let's
about
talk
that.
about that.
Commissions for all annuity types, and there's many different types. You can count anywhere from 7 to 10 types if you want to, however you want to. All commissions are built in and hidden from the client. Whether that's good or bad, that's something you need to take up with the annuity and life insurance industry, because life insurance companies issue annuities. But just understand this, the simpler the product, the lower the commission that's built in. The more complex the product, the longer the surrender charge, the higher the commission. And what you're going to get hit with stuff out there is market upside with no downside, market participation with principal protection, upfront bonuses, which I call candy for the stupid, because there's not an annuity or life insurance CEO that wakes up in the morning and goes, you know what, I want to give money away. No, these are for-profit businesses. These people sponsor sports stadiums, have big logos on the plane and big buildings for a reason. They're in the business for profit. Life insurance companies have the big buildings because they know when we're going to die and they price things accordingly. So if it sounds too good to be true, get up and walk away, because it is.
Yeah, yeah, that's that. I have to say, I have to share an experience. You're gonna love this. So I was talking to this an accountant of mine, a friend of mine, and he was like, "Hey, one of my clients just got pitched this annuity, and I'm worried about this guy." So he's very concerned about his clients. I'm very worried about him. Can you talk to him? And I don't sell insurance or annuities, so I
Mhm.
was like, "Sure, I can talk to him. I can explain what it is." So I talked to the client. He explains it to me. He explains what happened, and I'm not going to name the name of the company the guy
Sure.
works for. You'll
Yeah,
probably
please
know
don't.
exactly who
Yeah.
it is. But anyway, he gets through pitching this guy how he's going to make lots of money, he's going to make lots of income, he's going to do all this stuff, and he's got him bought in. And then in the same conversation, the client's like, "Well, I need to make more money. I'm thinking of changing jobs." And he's like, "Oh, I got something for you. You can sell these to your friends, and you can make lots of money, and you can make big commissions." Like, the gall of this guy to not only pitch him on this high commission product, but then in the same conversation say, "Oh, you can make lots of money pitching this to your friends," meaning like, I'm screwing you right here. Here's how you can screw your friends. I'm like, oh my God,
Let
like,
me explain that to you. This is very important. I'm glad you swerved into this, because people are familiar with multi-level marketing out there. I'm not going to mention that, let's just
yeah.
mention one,
It's
Amway. Don't care either way. It's just the one everyone knows, which you get your friends involved, etc. There are companies now popping up that are multi-level marketing companies to sell annuities, which means that if he would have convinced that guy to sell to his friends, he would have gotten cuts as well. This is the most asinine thing I've ever heard of in my life. I'm not sure where in the world it can be fiduciarily responsible to do that, but that's what that was. I mean, and that's incredible. Here's the other thing people need to figure out and understand. And I'm not sure a lot of agents and advisors understand this. The NAIC, the National Association of Insurance Commissioners, which kind of sets the rules, okay, they recommend that you place no more than 50% of your investable assets in annuities. That does not include your house, your car, your guitar, collectibles. We're talking about investable assets. That doesn't mean you have to put 50% in, but if someone is trying to pitch you, hey, let's take your entire 401k and ram it into an annuity, you've got to say, wait a minute, this is not a game. Stop playing games with my retirement. I mean, most people out there that are selling annuities, unfortunately, have passed a test, scored a 70 last week, and now they're talking to you about retirement. The bar is pretty low, unfortunately. That'll make everyone a bad person, but just ask hard questions, ask to see a specimen policy, ask for the contractual guarantees, and don't believe the hypotheticals and theoreticals and back tested return numbers that are shown to you.
so that's a great point, Stan. This is something that the whole industry does. They give you these illustrations, and there's like 200 pages long of illustrations, and there's like 10 illustrations in there, so you can use any one you want. Um, and I see this all the time, and it's so confusing that I'm not even sure the agents understand it.
They don't.
So what is, and I'll give you a side story. there was one time I had a client who asked me about some annuity they had. And I said, all right, give me the contract. Let me see it. I looked
Hmm.
through it. I looked through the illustration that was given. I had tons of questions. I actually called up the wholesaler and said, hey, can you explain this to me?
Hmm.
He couldn't explain it. Like it was just so confusing that it's almost like it's done deliberately. So why are these products so confusing?
They're confusing because they're profitable. In my opinion, that's why. I mean, they're profitable for the company, the agent. They're getting paid anywhere from, depending on what type of long-term annuity they're selling, 5 to 9% commission up front. Okay, so you have to understand that, but also understand, and I'm not putting down index annuities. We use index annuities as a delivery system for the income guarantee that you can attach to it. We don't look at the caps and the spreads and participation rates. And the reason we don't look at that is that with the vast majority of those index annuities, the company can change the rules at their discretion. Give you an example. Let's just say you bought an index annuity. The guy showed you a 10-year back tested return number, and it's a 10-year surrender charge product. What you, in essence, have purchased is a 1-year guarantee. In the other 9 years, the company can change the rules at their discretion. Why would you buy that? You would not. So, I mean, if I have a legacy in this business that I want to leave, is doing away with, making illegal the back tested return numbers that's being shown right now, because it's misleading to 13,000 baby boomers that are retiring every day looking for guarantees. Period.
So all right, so we know the insurance lobby is pretty strong, and so
Mm-hmm.
they allow it. And I guess in the foreseeable future, I don't see that up for change. Hopefully, you can make some headway. But let's talk about the different types of annuities out there, because I think there's a lot of confusion in the consumer market. I mean, frankly, they don't understand annuities at all. They just hear the sales pitch. Oh, I can guarantee you're not going to lose money. And technically they can say guarantee because the insurance companies guarantee it. I still think that's a little weird
Yeah,
when
but
I
you're
can't
only
say it.
talking about one type.
Right. Well, I can't say that word, but other
Yep.
people
So
can.
let's go backwards. Annuities were put on the planet in the Roman times as, in Latin, annua, meaning payment for a pension for the dutiful Roman soldiers and their families. You have lifetime income products called single premium immediate annuities, deferred income annuities, qualified longevity annuity contracts. No moving parts, no annual fees, no market attachments. Straight transfer risk products that are primarily based on your life expectancy or life expectancies when you take the payment. Okay. There's also another lifetime income product called an income rider that you can attach to either variable or index annuity. But if you're only shopping income riders, so if you go to my site and shop the income riders, we're shopping all income riders. We don't care about the underlying product delivering that. So those are the income products. Lifetime income, as long as you're breathing, it's going to pay. We can structure it so that 100% of any unused money, if you die, goes to the beneficiary, and the evil annuity company doesn't keep the money. So going back again, income products: single premium immediate annuity, deferred income annuity, qualified longevity annuity contract, income riders. You can quote those at my site at theannuityman.com 24/7, 365. Then there are what's called deferred products, principal protection products. One's called a MIGA, multi-year guarantee annuity, which is the annuity industry version of a CD. We have a live feed of that on my site showing all 50 states of what's available. And then you have the fixed index annuity, which, by the way, was put on the planet in 1995 as an alternative for a CD. It's not a market product. It's not a security. The fact that people are using the word market and market upside is illegal. They can't do that unless there's securities license, as you know, Kirk. So those are two principal protection products, which are CD products, MIGAs and index annuities, even though index annuities are the most overhyped product on the planet. Then you have variable annuities, registered investment products, etc. We can go into that have a little bit more market twist to them. But in my opinion, nothing against the variable annuity people out there. But if you want to buy mutual funds, go buy mutual funds. You don't have to buy an annuity wrapper to buy mutual funds. In the industry, that they call those separate accounts, but me and you call them mutual funds. So that's in essence the world of annuities. And going back to the PIL acronym that I've created, what annuities contractually solve for: principal protection's the P, I is income for life, L is legacy if you can't qualify for life insurance, and then the other L is long-term care. PIL. If you do not need to solve for those one of those items in the PIL, contractually, you do not need an annuity of any type, period.
So the fixed annuities, I remember when I started in 99, the fixed annuity, people were looking for the best rate, best yield. And back
Yep.
then you get 6% yield because that was the normal.
You still can. At the time of this taping, please check the date. At the time of this taping, you can get the durations of a multi-year guarantee annuity, which is what Kirk was talking about, which is the annuity industry version of a CD. The difference is you can put it in all annuity account types, IRA, Roth IRA, non-IRA, but in a non-IRA account, MIGAs, multi-year guarantee annuities, that interest grows tax deferred, but you can buy them as short a duration as 1 year, as long of a duration as 10.
Okay. So back when I started, you were competing against CDs and you were competing against
Mm-hmm.
treasuries and other things, and they actually had the best rates of fixed annuities, and it was great because it was an alternative if you were looking for fixed income.
And they still
Um,
do, Kirk. Let me stop you. Here's the
yeah.
rule. If your time horizon is 3 years and in, buy CDs and treasuries. If your time horizon is 3 years and out, like three or more, then multi-year guarantee annuities are historically going to have a better contractual yield than CDs. But CDs, money markets, and treasuries, that's short-term money. From 0 to 3 years, anything past 3 years, you can look at multi-year guarantee annuities.
Okay, that's a good rule of thumb. It's interesting.
Mhm.
What so how are the insurance agents, the insurance companies able to provide a better rate? I mean, what
Well,
makes
it's
them different?
when banks are setting rates, they're really looking straight at the Fed. Okay, they're looking straight at the Fed to price it. With life insurance companies that issue annuities, people need to know that life insurance companies issue annuities. They have many different things they're looking at. They're looking at a portfolio of lifetime income. They're looking at a portfolio of life insurance, and those are very profitable products because they know when we're going to die. Okay, they really do. They have a legacy bond portfolio in place, and then they start glancing at the Fed. So the Fed doesn't play a primary role in the pricing of those multi-year guarantee annuities. All the life insurance company that's issuing that multi-year guarantee annuity CD annuities looking at is they're going to give a contractual yield, and all they know is once they do that, they know that they can make 50 basis points higher. So give you an example. Let's just say at the time of this taping, you have a 5-year multi-year guarantee annuity yielding a guaranteed 5% annually. All that means is that the annuity company knows that they can make 5.5, keep the 50 basis points as profit, and give you the 5%. It's really that simple. And the reason they can do that is they have many different pricing arms that they can pull off of. Once again, life insurance, lifetime income products, legacy bond portfolios, etc. And then they can price it to beat that CD at the bank.
So let me ask you this, because I know we had 15 plus years of 0% interest rate policy, and now
Mhm.
that's changed. Now we're back to a more historically normal interest
Sure.
rate, which is great for retirees. Um, how has that changed the annuity market in the last 5 years? Because that's a big change. But how has the annuity market changed to adapt to that?
It totally changed the game. October 2022 was the first time in decades that multi-year guarantee annuity yields contractually were guaranteed above 5%. At that point in time, since that point in time, the annuity industry has really attracted a lot of people looking for safe money, principal protection, wanting the guarantee. And with a lot of these MIGAs, you can peel off the interest and never touch the principal. So it can serve as a pseudo income product if you want to just peel off the interest. But since that time, the industry has exploded because all of those people out there say, I hate annuities, annuities are all bad, don't ever buy an annuity. And we know who we're talking about. That's insane when you look at a product like a multi year guarantee annuity with no annual fees, no moving parts, just a contractual yield. And most people are very familiar with CD products. This is a CD. So they're like, wait a minute, I thought annuities, when I die, the annuity company keeps money. No, I thought annuities were all the income products. No, this is a principal protection product that has a yield attached to it, and the baby boomers flocked to it.
So you're seeing obviously a big uptick in that. What some of these other products, I know there's been like the equity index annuities, for example, and I know we're
Mm-hmm.
going back and forth here.
Sure.
Um, historically, from what I've seen, I've never seen one perform anywhere near the hypotheticals that they
No,
claim.
no.
And yet, when 2008 came out, they all claim, "Hey, we protected your principal. No one else is doing that." And yet, so they're coming out and trying to have their cake and eat it too. But in reality, I've never seen them really perform up to par. It always underperforms. So, how should people be thinking about that product in general?
It is a CD product. It was put on the planet in 1995 to try to outperform a CD return. At the current, check the date of this taping. At the current time, you're better off buying a multi-year guarantee annuity, in my opinion, because it's going to outperform the non-guaranteed cap spreads and participation rates. Now, understand this as well. The typical commission can be as high as 9% with index annuities. Okay. With multi-year guarantee annuities, the commission built in is 1% to 2%. So the reason that you never go to the bad chicken dinner seminar, expensive steak dinner seminar, and they'll never talk about MIGAs or immediate annuities or deferred income annuities or QLACs, because those are low commission pro-consumer products. They're going to always try to sell you that long-term high commission product and justify it. I'm not saying they're bad products. They do have their place, but they are not a one size fits all, period. What we do very simply at the Annuity Man is we ask two questions, Kirk. It's, what do you want the money to contractually do? And when do you want those contractual guarantees to start? From those two answers, we can determine, one, if you do not need an annuity, and we will proactively tell you that. And then number two, if you do, which type is going to provide the highest contractual guarantee? And then we quote all carriers. Because we only look at the contractual guarantees, what we have done is what should be done in the industry. We've turned the products into commodities, which means we shop all carriers for the highest contractual guarantee for your specific situation. If anybody ever says, I've looked at all annuities and this is the best one, they're lying to you. There is no best one. The best one is the one that provides the highest contractual guarantee. And understand that contractual guarantees are like a gallon of milk. Every 7 to 10 days, they change. You lock them in if you like the guarantee being offered for your situation. But that's the way to approach annuities. Unfortunately, we are the pioneer in that. It makes sense. It's the way they should be sold, and we're leading the way with that. We are the largest seller, but we only sell contractual guarantees. We will not have a conversation about hypotheticals. That's not who we are.
Okay, cool. So here's a topic I know you love to discuss, and it's one of my favorite topics. It's so much my favorite topic that I've never had a person on the show to actually talk about it because I
Here
don't
we
believe
go.
in it. Infinite banking.
I'm not a fan, okay, and I'm not going to name names and go into it. And I know the sales pitch, etc. All I'm going to say is this, and I have been approached by clients about this. Just to understand, there is no tax-free income unless you're buying AAA municipal bonds. When they talk about this product and this strategy, they're talking about taking a loan, LOAN, off of a policy. Loans are not income. Loans are loans. Okay. So if you go to the bank and you get a loan from the bank and you're getting money from the bank, that's not income. That is a loan. But somehow the sales pitch says, well, you buy this life insurance policy and you take a loan off of it, and that's tax-free income. We're talking about word games and semantics. I'm not a fan of that. I understand the sales pitch. Believe me, they have called me a million times and tried to make me a disciple, and then I just kind of go down the factual path of questions. But you don't need that. You don't need to be fancy. I tell people all the time, in retirement, which is chapter 2 of your life, keep it simple. If you cannot explain it to a 9-year-old, no offense to 9-year-olds, don't buy it. Period. And so that's all I have to say about that. Just remember this, all the people listening, it's a loan. Okay. It's not tax-free income. It's a loan. If you remember anything, just remember that.
Okay. Well, that's helpful because you're being kind, I think, to the product
Oh,
today.
I'm being very kind.
Yeah, I get this question a lot from clients. Like, oh, I got this pitch in infinite banking. You can borrow against yourself, and you can grow at 4 or 5% or whatever. I'm like, I don't understand your math. So you're giving them money, and they're giving you your money back. Okay.
All I tell people with any product, this one, whatever, look only at the contractual guarantees. Buy it for what it will do, not what it might do. Never, ever, ever buy it for the hypothetical, theoretical unicorns chasing the butterfly numbers. Buy it for what it will do, which is the contractual guarantee. Don't believe me? When you buy something, life insurance policy, annuity policy, you're going to get a contract in the mail. They call it a policy. I call it a contract. Buy it for the contractual guarantee. So if you're being pitched something, tell that eager agent or advisor, please show me the contractual guarantees. Please show me zero. I want to see zero and how the fees affect zero. Now, they're going to come back to you and say, well, that's never going to happen, sir, because we looked blah, 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 blah. And you say, do me a favor, humor me, show me zero. Once you see that, you're going to see those fees eat that policy up from the inside out. I'm assuming you agree with me, Kirk.
Oh yeah. Yeah. What fees, Stan?
Okay.
This is
Okay.
there's no commissions involved in these things.
Yeah. Okay. Just ask that question. And if someone hesitates to give you a specimen policy, or if someone hesitates to show you a zero return, then they're not your advisor. I mean, you're talking about your retirement. That your advisor has to be transparent. There is no urgency to buy a contract. I love it when they say, well, you pretty much have to sign right now because the bonus is going away and blah, blah. Listen, there's no urgency. This is a contract, period. Take your time, understand it. And if you don't understand it, don't buy it.
Yeah. Yeah, no, that's helpful. So as we're just trying to think of other topics here. The infant banking one's a big one that I hear a lot. What other areas are kind of common mistakes that investors, or actually, here's one before I ask you that one.
Sure.
I hear a lot. Sometimes it's associated with infinite banking. Sometimes it's associated with other things. But people always talk about, well, the wealthy use this as a way to build wealth. Well,
yeah, the Rockefellers use this. Okay, great.
Yes, they didn't make their money in oil. They made it.
No, they made it in life insurance products.
So what are some of the biggest things that you've seen people make mistakes on with annuities or missold?
Well, the first thing is just the category itself, thinking that there's only one type. A lot of people say, well, I would never buy an annuity because when I die, the annuity company keeps the money. That's garbage. Just to go backwards a little bit, all lifetime income products can be structured so that it will pay as long as you're breathing. Even if you're on a ventilator till 175, they're on the hook to pay. But we can structure it so that if you die early in a fiery Learjet crash, then 100% of any unused money goes to your family and not the annuity company. So it's a transfer of risk. People say, well, what's my ROI on a lifetime income product? I don't know that until you die. If it's joint life, I don't know that until the second spouse dies. And we can structure the joint life policy so that the income continues uninterrupted and unchanged. I guess the biggest thing with lifetime income products, people need to understand it's customizable. Okay. It doesn't just do one thing, because I know there's commercials, never buy an annuity. Well, that's kind of crazy because everyone already owns one. It's called Social Security. I think annuities as a category are the perfect solution for what I call income floor. Your income floor is the amount of money you need in retirement that doesn't is not going to be affected by whoever is in office, global events, etc. It's the pension type money. Social Security is a pension from your employer if you're so fortunate. That's an annuity. What is that amount that you need to hit your bank account every single month? Now, we can structure that, and buy an immediate annuity can solve it right now, or you can buy deferred income annuities or QLACs or income riders to solve it in the future if you are a planner. That's the one thing I want to kind of drive home. Annuities are primarily for income. Now, if you want to protect the principal, like I said, multi-year guarantee annuities do work, in conjunction with CDs and munis and treasuries and high-yielding money markets. That's the safe money. But the biggest mistake made with annuities are people buying hypothetical, theoretical, and hopeful return scenarios. Never do that. If you want market returns, real market returns, with unlimited upside, never buy an annuity, period. End of story. Because you're going to be limited either by the limitations on the upside with, say, an indexed annuity, or you're going to be limited with the choices with, say, a variable annuity in the mutual fund separate accounts internally. So if you walk away with one thing, is when I say pill, principal protection, income for life, legacy, and long-term care, there's no G for growth, there's no M for market. So if you need G or M, do not buy an annuity.
So one thing that comes up a lot is obviously inflation.
Mm-hmm.
Inflation, most people peg it to the CPI, which of course nobody believes is accurate.
It's
Uh,
not.
Certainly not for anything I'm buying.
No.
My food prices have doubled in the last few years, and I think food prices on that are only 20%. I'm like, I don't know what they're
Right.
marking. Maybe it's spam. Maybe it's but even McDonald's Big Macs are up from like $1 up to $3 or whatever it was. So I don't know anybody buys that. But I do want to point it out because obviously it's one of the problems with Social Security, with anything that has any sort of inflation rider. How can people protect themselves against inflation with
Okay.
annuities if the markers are inaccurate?
This is why I'm glad I'm on the program, because you're going to hear as a consumer, someone's going to tell you they have an annuity that adjusts for inflation. They are absolutely incorrect. There is no such animal. Once again, annuity companies, life insurance companies issue annuities. They have the big buildings for a reason. They don't give anything away. You can attach what's called a cost of living adjustment, COLA, to say an immediate annuity, a deferred income annuity, which means it's going to increase every year by that percentage. But once again, annuity companies don't give that away, and they typically lower the initial payment when compared to the exact annuity without a COLA. They lower it by 30 to 40%. So mathematically, it doesn't work. When you look at it, well, that sounds great, it's going to increase. No, the way to solve for inflation with annuities is going back to my income floor example. Let's just say your income floor is $4,000, and next year you need $4,250 looking at your expenses. You go to my site, theannuityman.com, run what's called a reverse engineer quote. Very easy. You put in, we need an additional $250 a month for both of our lives, and then quote it. So in other words, with inflation and annuities, there's not an annuity product package that tracks it and addresses it. You'll hear the sales pitch that it does. It does not. You're talking to the number one. I am the number one agent in the country for a reason. Okay. When you're going to do inflation, at the time you need additional money, you run the reverse engineer quote, solving for that monthly amount that you need, and you buy it right then. That's how annuities address inflation. And that's the only way annuities really address inflation. Everything else is a bad sales pitch.
Okay. All right, cool. So what else? What else, Dan? I mean, what are some other areas you think are relevant given given what's going on in the world? I mean, one thing that obviously pops up is a lot of people are afraid of the next black swan. They're afraid of a civil war. They're afraid of the sky falling. I mean, there's so much fear being perpetrated in the media nowadays. People are afraid of everything. So how should people be thinking about this as an asset class to add as a part of their portfolio, if at all, but if it is, like, how should people be thinking about using this given the state of the world?
Annuities should be looked upon and utilized as a non-correlated asset, which means not involving the markets. It's a contract. So you're putting contractual guarantees in place. These are transfer of risk products. Once again, principal protection, income for life, legacy, and long-term care. That's what they do. And that's how you need to position them in your portfolio. If you need lifetime income to supplement the annuity you already have, Social Security, which is the best inflation annuity on the planet, then you need one of the four lifetime income products: single premium immediate annuity, deferred income annuity, QLAC, income rider. It's really very basic on how annuities work when you break it down to what they solve for. And most people need additional income. And people that are going into chapter 2 of their lives, they're looking for contractual guarantees. So if you say, Stan, we really don't need income, the income's fine, then you would move toward possibly like a MIGA, multi-year guarantee annuity, a CD annuity, which protects the principal, and in a non-IRA account, the interest can grow and compound tax deferred, even though you have access to that interest with most of the carriers. Annuities are simple, okay? They're very, very basic, but in a portfolio, they are there to complement what you have. I actually think the income floor part is very important. So let's just say you have 50% of your money in the markets, mutual funds, ETFs, it's managed well. Kirk and the guys are doing their thing. Okay. If you have the income floor in place, then you don't have to disrupt that market stuff if there's hiccups in the market. One of the things that's out there that I want to squash like a bug, and people like Wade Fowl have squashed like a bug factually, is the 4% rule or the 5% rule or the 3% rule, meaning that you don't need to buy a contractual guarantee annuity, Mr. Jones. We'll just take your portfolio and we'll just peel off the gains. Well, that's great until there's no gains, and then you're eating into it. I think if you have the income floor in place, not only are you going to be a better investor, but your people managing your money will be better at their game because they don't have to sell into something that they don't need to sell into.
Yeah. No, that makes a lot of sense. Certainly, it's so. Let me ask this. This certainly comes up a lot. I mean, I run into a lot of people who already have annuities,
Mm-hmm.
and I every once in a while I come into a new prospective client, and he's got like 10 different annuities. He's got no other assets. Everything's in some sort of annuity. He's just he's a bullseye walking around looking for an arrow, basically. And
Mm-hmm.
how should people be thinking about if they already have something and maybe it's not the best for them, but what should people do in that situation? Many times they have surrender charges, which complicates it. And so just hypothetically, or just how should people be thinking
Yeah,
about that?
let's talk about that. Let's just say you have an annuity, it has surrender charges. What you cannot do, and a lot of agents will try to do this, is they'll try to switch you into another annuity and claim that the upfront bonus will make up for the surrender charges. That's illegal. They can't do that. And you should never do that. Here's the other problem. A lot of people have bought, say, index annuities or variable annuities with income riders. The income rider value is much, much higher than the accumulation value. In the English, accumulation value means walkaway amount. The income rider, which is monopoly money, can only be used for income. That's not transferable. So in essence, you're stuck with that annuity and that annuity company because that income rider guarantee that is so high does not transfer. Now we can run those analyses, whatever, for you. If you have an annuity that you're thinking about getting out of, we can run the contractual numbers to see if it's possible. 80% of the time, it is not possible. You have to understand that the annuity companies structure these products so you can't get out of them. Single premium immediate annuities, deferred income annuities, and qualified longevity annuity contracts are what's called annuitized products. You can't transfer out of those. Those are income products. But the ones that are being sold out there, primarily the index annuities, the variable annuities, if there's an income rider attached, like I said, 80% of the time you're stuck there and you need to make a decision whether you want to turn the income on or not. But it's just a straight math situation for us. And understand, if you did decide to transfer, or someone is says we need to transfer the annuity you have to an annuity that I have, by law, during the application process, they have to do a side-by-side written comparison to prove mathematically that the annuity you're going to is contractually better than the annuity that you're coming from. That's where a lot of games are played by agents, but there's no games. They can lose their license if they fudge those numbers, because you should never move the annuity you're currently at to a newer annuity if the guarantees aren't higher.
And what about moving out of an annuity completely and just not being in any annuity?
Nothing wrong with that. If you say, you know what, I'm going to vomit if you say the word annuity to me again, Kirk, then take your lumps, take your hit, and put it in the markets or whatever you wanted to put in. But yeah, that is always if someone bought 10 annuities, they bought too many annuities. Period. It's just there's no question in my mind. I mean, they're the nail and somebody was the hammer. Okay, but the point is, there's nothing wrong with saying I don't want to do that. Or let's just say you bought an income rider attached to an index annuity, you don't need income in the future anymore, then move out of that. You don't need to be paying those fees, because understand, fees for variable annuities or income riders attached to index annuities are for the life of the policy. Okay, life. So you need to run those numbers to see if it makes sense for you to exit out, maybe take a hit coming out, but you'll make that up with good money management and good decisions.
Yeah. Okay. That's good knowledge. All right. So as we get close to wrapping it up here, final thoughts you think the listeners should know about?
Well, for the people out there that are in chapter 2 of their lives, or looking at retirement, or thinking about retirement, planning for retirement, or in retirement, just understand that for lifetime income, as long as you're breathing, annuities are the only product that can provide that transfer of risk contractual guarantee. That doesn't mean you have to buy one, but you already own Social Security, which is an annuity. So you can't say, I hate all annuities. then go to Social Security office and cancel the payments, because that's what an annuity does. It's going to pay you. I would just be very, very careful out there, because right now, with 13,000 plus baby boomers retiring and looking for guarantees, and not sophisticated with the markets in a lot of cases because you've been working, don't fall for the sales pitch. Don't buy hypotheticals. Buy contractual guarantees. We say all the time, own an annuity for what it will do, not what it might do. And if you base your decision solely on the will do, then you'll be fine. And I would encourage you, we're not going to call you or chase you. We're a licensed in all 50 states, distributor and seller of all annuities with pretty much every single company out there. But you can go to the site at theannuityman.com and run quotes to your content. No one's going to call you. We don't have some sophisticated algorithm to track you down. We want you to be able to kick the tires and look what the numbers are. Just understand this. With interest rates going up, people say, well, I'm waiting on the interest rate. When you're buying lifetime income, the primary pricing mechanism is your life expectancy, or your life expectancies, if it's joint, at the time you start the payments. Interest rates play a secondary role. Once again, interest rates play a secondary role. So if you're looking for lifetime income, the older you are, the higher the payment. Is the payment higher when you're 65 or 70 with Social Security? 70. Why? Because you're older, you have less life expectancy, fewer projected payments, which means those payments will be higher. It's really that simple. So for all of you out there looking at annuities, and you probably heard good and bad, break it down to the simple contractual guarantees, run the quotes quoting all carriers, and you'll be fine.
Right. Well, Stan, I really appreciate you coming to the show and sharing your wisdom with us once again. This is always a joy for me, because we get pitched multiple times a week to bring on some of the clowns that I know what they're going to pitch, and we always turn them down because I couldn't stomach, even if I was sitting there for a half an hour to make fun of them, I couldn't stomach that. So
it's horrible. I would tell people to go to my YouTube. I got a YouTube channel called Stan the Annuity Man, and we have 1,000 videos, and they're not salesy videos. They're edutainment videos where I am explaining the truth about all this. And I think you can go there. We have them categorized by whatever category you want, whether it's product or whatever, inflation, and you can watch and get educated to see if these fit. Listen, annuities aren't for everyone, even though everyone owns Social Security. But you need to look at it and get educated, not get pitched. That's all I'm going to say on that.
Yeah, it's really hard. I mean, there are some advisors out there who will offer you annuities for no fee annuities, like fee only, which oddly enough, there are very few of those that exist to be able to be offered.
Less than
Go
five.
Go
Less
figure.
than 5.
But
Absolutely.
they do exist, and
Yep.
and certainly. By the way, what do you think of those? Do you think those are worth it if they don't have commission attached for the
yeah,
advisor?
and what he's really talking about is the no load variable annuities, and there's less than 5 that are even worth looking at, but in my opinion, not worth looking at, because you're still limited on your mutual fund choices. My opinion, just go buy mutual funds. You don't have to wrap it up in some, when you buy a no load mutual fund, no load variable annuity, you're limited to the mutual funds offered within that no load variable annuity. Why not just go buy mutual funds? There was one, unfortunately, that was very good. It got purchased by another company, and of course they ruined it. So I'm not going to name the company, but it had like 400 choices, and now it doesn't exist anymore. My opinion, buy mutual funds. You don't need the no load variable annuity wrapper in order to do that, and all you're doing is limiting your choices.
Right. Or you could just buy an annuity and then throw it into a retirement account, right? Because that'll do you a lot of good.
Well, let's cover that real quick. I mean, all
Yeah.
annuities can be used in IRAs, okay, Roth IRAs, non-IRAs, whatever. If you're putting an annuity of whatever type inside of an IRA, you're not getting double tax deferral. You're buying it for the contractual guarantee, which is okay. But yeah, most annuities are purchased inside of IRAs. Why? Because that's where most of the money is. But you don't have to do that with, let's say, a variable annuity. You just buy the mutual funds inside the IRA. If you're buying a contractual guaranteed lifetime income stream, you can do that with inside of an IRA, and the money coming out obviously is going to be taxed. So regardless of account type, annuities work. We just have to make sure that it's a fit for your specific situation.
Absolutely. Well, once again, Stan, appreciate you joining us. Thanks for going on. We'll definitely have you back on in the future.
Thanks, Kirk. Appreciate it.
Hey, Doug, did you hear? We're giving away free money. Well, I'll tell you about it in a minute, but before I do, there's a saying in the mining community, well, precious metals mining, that is. The saying is that if you want the best deals, you have to be in the room. Now, you're probably thinking, what does it mean to be in the room? Well, I'll tell you. Being in the room means that you're on the short list of people who get invited to be a part of the best deals. These are the deals that most investors will never have access to. Mean like IPOs? Nope, IPOs are chump change. Those are for retail investors, small potatoes. That's nothing compared to these deals. These deals would have you salivating to get access to them. Once you know they exist, you will never look at investing the same way again. I almost don't want to even tell you that they exist because it will ruin your thinking of how the investing world really works. Now, you might be excited that these deals exist, but you only have access to the deals if you're an insider, or in the room as they call it. Now, as loyal listeners to the show, I'm going to give you a chance to be in the room. Money Tree Investing Podcast has created the Insiders Club. This is a community of our show's members who are loyal listeners of the show and want to get more out of their investing experience. Being a part of the Insiders Club gives you insider status for upcoming events and webinars, discounts, free stuff and books, and influence on the future direction of the show. This is a great opportunity to join us as we expand our content and services. Oh, and did I mention free money? Yes, in the next few weeks, I'll be giving away free money to our members of the Insiders Club as my appreciation for listening to the show. Now, there's no cost to join the Insiders Club. Just go to moneytreepodcast.com/free money today to join the community. That's www.moneytreepodcast.com/free money. I hope to see you in the room. All right. Well, that was a great interview with Stan. Really appreciate him coming on the show. Always appreciate his humor. Now we're into the panel portion of the show where you have our very own Megan Gorman. Hey, Megan.
Hey, Kirk, how you doing today?
Doing well, doing well. And we also have our very own Phil Weiss. Hey, Phil.
Hey, Kirk, good to see you. How are you today?
Good, good. Well, let's just dive right in. So, Megan, what were some of your thoughts from the interview?
First, I gotta say, I like interviews with Stan. He is a fun interviewee, and look, annuities are a hot potato topic, right? People don't feel in the middle about them. You either really like annuities or you really don't like annuities. And I think the more sophisticated you are as an investor, you end up in that don't like annuities category. But for me, in listening to Stan in the interview and how I work with clients, after 22 years of doing this, I think that annuities do have a place at times in people's portfolios. But like anything, there has to be a reason or an idea behind it. And I think one of the things that we have to always keep in mind is since the early 80s, we've moved away from a pension like system. And for most Americans, that's incredibly challenging. So if done appropriately, I think annuities can be a great thing to be like a pension in your portfolio. And then, as I was saying before the show to Phil, for a lot of people, like I'm 13 years younger than my husband, sometimes the idea of using an annuity as a long-term care instrument can give peace of mind. So I don't want to throw the baby out with the bathwater, and I know we'll get to it, but I think if you've got some really constructive reasons to put an annuity in your portfolio, it may make sense.
Yeah, and we'll get back to that. Megan is what is called a trophy wife, right, Megan?
Well, my husband just retired, so technically he's the trophy husband now.
Well, we can get into the tax part of that because I don't know if what it's technically called, but we kind of call it the trophy spouse kind of provision if it's over 10 years. So we can get into that later.
And we get to use a different section of the required minimum distribution table when we take from our IRAs. So it's quite nice.
Yeah. So we'll get back to that. So Phil, what are some of your thoughts?
So, I have to be honest, when I first saw the title of the interview, it's like, oh no. Because I'm definitely in the not an annuity camp. But when I listened to the interview, I appreciated the fact that he took a more reasonable approach to things. And I know that there are times that for certain people, as Megan said, an annuity can make sense. I'll tell you, most of the time when I get a client that comes to me with one, it's something that they shouldn't have, because when you look at all the details and you get underneath it, it just wasn't a good it wasn't a good investment. It was very expensive and it didn't really do what they wanted. But you can get to points where they can make sense. Megan, you mentioned long-term care. I have a client that she tried to put an annuity in to do that, but what she picked wasn't really the right thing. And now we're going to look and see if there's a way that we can possibly do something different with it.
Yeah, it's interesting. I like Megan and Phil, I've been in the industry for a while, and I've gone back and forth on annuities. I've annuities are, I like the way Stan describes them, which is why I bring him back on the show, because he's thinking about it the right way, right? And there are a lot of yahoos out there, and we're going to talk about this a little bit, but there's a lot of yahoos out there that talk about annuities, and so you get this very black and white opinion about annuities. And so I've kind of gone back and forth, definitely 100% no. Like, all right, there's some validity there, and I think the problem is the industry is so shady, in the sense that these insurance people or annuity people, I would refer to them as, they say they're financial advisors, but all they are is just product salespeople. And I think the challenge I have is these people, if you're a hammer, everything looks like a nail, right? And these people are hammers. And it's like, oh, yeah, it's annuity. Oh, you don't have any money. Annuity is good for you, right? You've got a lot of money. Annuity is good for you. Like, no matter what your situation is, annuity fits it. And it's just not necessarily the case. But as Phil says, I mean, there's definitely, I'm not, I'm a little bit agnostic. I have my opinions, but I think in general, I look at it and say, look, there's a time and a place for everything, or else the product really wouldn't exist if there wasn't a time and a place for it. I think the challenge is that people oversell them. And when I come across these new prospective clients, and they've got like 10 annuities in their portfolio, I'm like, ugh. Like, I just have that like ugh feeling. Like, this person's just gotten run over by a steamroller by 10 different annuity salespeople, and they somehow think it's a good idea, and there's probably no plan in place. It's just, hey, you just were willing to give this person 50 grand, and so now you got an annuity, shiny new annuity contract. So I think there's a challenge there, but it doesn't mean that they're worthless. There is some validity to them if they're used properly. So, Megan, how should people be thinking about annuities when it comes to planning? Like, what's you've got a tax background, so there's some pros and cons to annuities. How should people be thinking about them?
Well, first of all, it shouldn't be your whole portfolio, right? It should be one piece of it, and it should be there to serve a purpose. And so what I think is really important is, when working with a client, is going very slow with annuities, if we have one, and being able to articulate and put in our investment policy statement the role the annuity is going to play. And I will tell you, I have watched clients go through markets ups and downs, and a lot of times the annuity makes them feel better in the down market. But I think when you're going to put an annuity into your portfolio, one of the biggest challenges is the illustrations. Now, insurance is regulated by the state, so there are certain requirements that has to be in the presentation. But I find these presentations incredibly confusing. And I'm not a shrinking violet, because I'll drill and ask tons and tons of questions when these are put in front of us. And so what I would tell people is, when you're looking at an annuity illustration, don't just take it and assume that that's how it really works, right? There are things factored in that might not play out. Like, there might be a certain rate of return factored in. And so when you're going through these illustrations, I would suggest to say, okay, but what happens if the market never goes up? And what happens if the market goes negative? And what happens if I have to tap into it immediately? How does it actually play out? Because the thing is, a lot of these annuities are constructed assuming a certain rate of return, and that you're not going to touch it for a certain number of years. And if you don't stay within that wheelhouse of assumptions, you may cause the annuity to not play the role that you want it to be in your portfolio. The last thing I'll say, because I want to make sure I hear what Phil has to say, is when I'm building long-term scenarios, I like clients to understand what pieces of income are going to come in simply by waking up every morning, and what pieces of income are going to have investment risk on us. And so the annuity, like Social Security and pensions, all you have to do is wake up in the morning and that check comes in the mail when it annuitizes. And so it's really good for people to understand why you're going to probably pay a little bit more for the annuity in order to get that predictability.
Yeah, and obviously in retirement, predictability is really important for a lot of people. Phil, what are your thoughts when it comes to planning? I know you may not be a pro annuity guy, but like, what are your thoughts on how this could be used?
So I guess one thing that I will say I don't like to see is when somebody takes an annuity and it's in a qualified, like an IRA account, because you're taking a tax shielded product and you're putting it in an account where there's already a tax shield. So it just doesn't make any sense. You lose some of the benefits that come with it. So I always kind of cringe when I see that one. But when I look at annuities, if we have somebody that's concerned about market volatility and they want to know that they have a certain amount of income coming in, that's when they can make a lot of sense. But there's certain types of annuities I wouldn't touch, right? I wouldn't go to variable annuities. They're always sold because, oh, they put a floor on what's going to happen to the market. But let's talk a little bit about how that works for a second. They also have a cap, right? So let's say the cap is 8 or 10%. That's the market's long-term return. That counts all the years that the market's really bad. So if you put this cap at 10 and then you don't lose, your average return is going to be something like 5 to 6%. So you're not going to get anywhere near the market return. And they're sold as, oh, it's safety because you don't go down when the market goes down. But you have to remember, when the market has good years, we have markets that go up 20 and 30%. You don't benefit from those. So those type of annuities, the variable annuities, the index annuities, and the UILs and all those type of annuities, those I don't like. But if I'm looking for income and I can get a single premium income annuity or deferred annuity that's going to provide to me, I make an investment, and either starting now or starting at some point in the future, I'm going to get a certain amount of income every year. Those can make more sense because in the fixed income portion of my portfolios where I'm not using annuities, I'm often using treasuries. And why am I using treasuries? Because I know what the return is going to be. I know what the income that they're going to provide is going to be. They take some of the volatility out of the portfolio, and I know what their value is going to be at the time that they mature because I can ladder them. So you can do the same kind of thing here. It's so much of investing and thinking about it is behavioral. And if we can take away some of the effects that behavior can have, we're gonna be better off over the long term.
Yeah, no, I agree. I mean, it's funny because when we're going to get into the annuity market itself in a bit, but I agree with you, Phil. I mean, I think the variable annuity market is sold. I think the challenge that I see is, I mean, there's different types. There's the equity index annuities, which are, in my opinion, toxic. I mean, the regulators don't even want to touch it. Like the insurance market doesn't want to regulate them. The securities market doesn't want to regulate them. So they're in this like limbo stage in the middle, and no one wants to touch it. And yet these things are toxic. I think the challenge is, as you said, Phil, like when the markets go up, these things don't participate in the same way. When the markets go down, the annuity industry comes out and be like, hey, people didn't lose money. Hey, we didn't lose money over here. It's like, yeah, you kind of did. You didn't lose money on some hypothetical number that you had there, but if you had to pull your cash out today, yes, you did. You lost money. And so, there's a concept called confusopoly. I was listening to a podcast, and people don't even know this is a real term. This is actually a real term. Confusopoly is when you have an industry or a business model that is effectively a commodity. So, you can't discern one from the other, right? A confusopoly is where the industry makes it so confusing that you can't discern one product from the other. And the annuity industry or insurance industries like this, the college industry, the healthcare industries like this, in effectively, you can't tell one from the other because they make it so really confusing, you're basically guessing. And so any industry that has to do that, it's got to make you question, what is the value of this thing? Right? Am I getting my money's worth for this thing? Now, if you look at medical care, I think we'd all agree we're way overpaying for most of it. College, I don't know. People say it's a negative ROI now for the cost. I mean, I don't want my kids are going to be, I don't know what's going to cost when they're in college. 100 grand a year. Is it worth that? I don't know. Maybe just give them 100 grand to be better off. But the point is when you have these industries where that's happening, it should, trigger something in your mind that says, isn't that interesting? Like, why is it so confusing? So if I have to call an annuity company to try to understand a product that a prospective client has, and I have to figure it out, and I can't figure it out by reading the contract, and I have to call them, and they can't explain it to me in simple terms, that's a problem. As you know, and I like Stan's take on it, because Stan's take is basically, if it's not in the contract, don't do it, right? If it's not, in writing, very clear as day, this is what's going to happen, don't do it. Because they throw in all these hypotheticals and this factor and that factor, and if this happens and if that happens, what if? I'll tell you, I've only seen one annuity contract that wasn't simple. And there's so many varieties, I'm not going to try to explain it, but that's not plain and simple. That actually worked out the way people expected. Right? You get these quote unquote hypotheticals that they give you. I've never seen one of those work out as the hypothetical projected, good or bad, right? It's just, it never turns out the way you expect. So why do you want something that is random chance? And these annuity companies are smarter than all of us. They're actuarials. They know what the numbers are going to be. Like, we don't. Isn't that a problem? Like, they're not doing this because they're nonprofits. They're doing this because they're making money, and make a lot of money. And so much so that they're able to compensate the insurance agents quite a bit. And I do want to talk about that, Megan. You had mentioned this before the show. How has the annuity market changed over the last few decades? Because, I mean, the advisors, it seems like they're selling more and more of these.
Yeah, I mean, it is changing. So, it used to be when you sold an annuity, you got a commission, whether the commission was paid in one lump sum or over the first few years. What's happened is the frustration that a lot of people feel about the annuity industry, that it can be at times sort of predatory, that feedback has been heard. And so some insurance companies have sort of shifted. And what they're doing now is moving away from commission-based annuities and instead doing what we call an asset under management, or AUM-based annuities. So instead of, when you do an annuity, you pay a commission up front, rather the mutual funds are managed by your investment manager and they charge their normal AUM fee on it. And that is how the person who sells you the annuity is compensated. So what it does is it aligns the interests a little bit better than just paying someone an upfront commission. So if you are being pitched an annuity, the things you have to ask, very important, is how are you being paid? One, and two, how are you going to monitor this, right? And so if you think about those two questions, the AUM-based compensation makes a lot of sense because your interests are more aligned. And at the same time, one of the things that doesn't get talked about a lot, and Phil brought it up briefly before that we got on this, is these annuities go stale, right? You can have a great annuity and then 15 years in, it's not so great anymore. And you're going to have to know when it's time to do an exchange, a 1035 exchange for a new annuity, and you need someone monitoring it. So you have to, and I make sure any annuity that my firm works with, we're looking at the annuities and checking in with the insurance company to make sure they are still functioning as they are supposed to. So that's the big shift going on in the industry. I think it's positive because, again, it's a better alignment of interests than a simple commission upfront.
Yeah, I agree with that, Megan. And I actually want to pull out something you said and highlight it, which is asking the question of the advisor, their insurance agents. I don't like calling them advisors because, they're insurance agents. The question is, how are you getting paid? Now, most people ask, what is the cost for me? right? Because they're worried about what's it going to cost me for you to sell me this. And they're just like, oh, it doesn't cost you anything, right? That's what they say. That's their answer. Well, it doesn't cost you anything. Really? Like, can you actually say that with a straight face? So rather than, because there's obviously a cost, there's expenses and all that that's built in. And so if they tell you that, they're lying to you, because of course there's a cost. There's a cost of everything. And also, I also want to point out for those of you who are listening to the show and you're thinking, well, I didn't pay any commissions to this guy. So you always have to ask yourself, is this a charity? Is this person working for free? No, they're not working for free. So if they're telling you there's no commission or no cost to you, the question you should ask is not what's the cost. The question you should ask, as Megan pointed out, is how are you getting paid? Because that is hard to sidestep. How are you getting paid? Because they can't say I'm not getting paid. Of course they're getting paid, right? But if they say, well, there's no cost to you, that's just a bait and switch. You know, it's like, no, how are you getting compensated? And then they actually have to answer it unless they're lying to you, because of course they're getting compensated. They wouldn't sell it to you. And I think what you'll find out, and this is what gets into Megan was saying, is the insurance agents get compensated so well for selling these things, it's obnoxious and it's going to make you not like them. Like if you're getting paid 7, 8, up to 10% for an annuity, the question you should ask yourself as a consumer is, how am I ever going to make money if 10% off the top goes to the agent? Now, not all of them pay 10%, but you know, they pay, most of them pay above 5, you know, 5 to 10, somewhere in that range. And the lower quality of the product, typically the higher percentage that they get. So the question you should wonder is, well, if they're getting paid so much, how am I ever going to make money? And I think what you'll realize is you tend to underperform because they're taking out so much. So when I was at Payne Weber, they had these syndication products. So some of them were like preferred stocks, which are basically a bond, but preferred stock, and be like, oh, it's great. It comes out $100 a share, and it's awesome, and you should buy some, and this, that, and the other thing. And as soon as it comes out, the price goes from $100 down to 95 instantly, because there was a 5% commission attached. But the client didn't pay it. It was a syndication, so it was built into the price. So immediately it goes down to 95. And the client's like, what happened? Why is it down so much? It's like, well, that was the commission. The market discounted it for that. And so the industry tries to hide commissions in many different ways from the client because they think, well, it'll be easier to sell. But all they're really doing is lying to you. And I'm not saying the advisors are, but the industry is. The industry sets it up so it's easy to lie about these things. And they don't make it simple to be transparent. So like Megan says, like the trend of being transparent, it's great, but there still aren't a lot of annuities out there that are fee only, or they're set up to be fee only annuities. There are very few. So I think that's a great trend. I totally agree with Megan. It's a great way the annuity industry's heard them. But now you have to have, now you've got to convince the other part of the industry that's so disgusted with the prior behavior that, hey, annuities are a good idea. And you have to also train the public that, hey, you can do these things and they're a good idea, when you basically commission bombed them for like decades. So I think it's going to take a while for the industry to turn around if that's their direction. I'm not sure if it is. I mean, they might be placating certain people, but if that's the direction, kudos to them. But that's going to be a hard road uphill in the snow with no shoes both ways. Like it's going to be a hard road for them to take. It's a good road, but I think it's gonna change the industry quite a bit, and we'll see what happens. There's still a lot of people who are convinced that they're not paying any commissions on annuity products. So, what are your thoughts, Phil? What do you think is the direction for the annuity industry?
So I like what Megan said as well, because I think that is a better direction. The issue too is that you also started to say this, when you're buying annuities, that's not a financial advisor that you're working with. It's very different. It's a product salesman. And that's his job, is to sell you product. I mean, I have a client, one of my first clients that I got, she was sold an annuity to fund her daughter's college education. not a 529 plan, but an annuity. And the worst part was, you talk about the fees and the costs that were in it. When we looked at it, she would have suffered it. It was a tax loss to get rid of that annuity because it was still worth less than what she put into it because of all the fees that were embedded in there. Because it's not just the commission up front, it's also the different charges, the annual charges that come in it that can be 2, 3, 4%, depending upon how it's structured and how it's invested. So you have to be really careful about that. And then I've seen annuities where you want to exchange them, but they have this protected withdrawal value associated with annuity, which is a fictitious number. And the returns that they get are based upon that fictitious number. So now if I want to exchange it or do something else with it, they're actually going to get less until we grow into that number. So it's not so easy sometimes to get out of these things. It's like, they're not great deals, but then once you get in them, the way that they're set up, they're hard to get out of without feeling like you took another loss. So anything that can change in the industry that brings more transparency and people being more willing to talk about, here's how I'm compensated, is only a plus, because it's a difficult industry. I know Megan mentioned this earlier. She gets confused by some of the projections and things like that. I do too. So, and this is the kind of stuff that we deal with all the time. So if we're getting confused, think about the average consumer. They really are in a bad spot because there's somebody that comes and they're trying to sell them a product, or a salesman. And there's so many things from a sales perspective that you can do to influence a person to get them to purchase from you. And now what do you do? And now they end up with these products that really don't suit their needs at all.
It's
Yeah,
interesting,
go ahead,
Phil.
Megan.
It's because like we all feel so strongly about this, but there is one thing I have liked about annuities that I'm actually considering for myself. And maybe it's because I think I've shared with you before, my husband's 13 years older, but and I've had to caretake for parents, but there is the advent of the long-term care annuity. So it's either a rider in the annuity that allow you to take money out for long-term care tax-free, or it's an annuity that's specifically created to be used for long-term care. And they're very hard to get a hold of, right? I have a few clients that have them and I can't even find them anymore. But one of the reasons why I think it's important is we are in a retirement and a longevity crisis. And in particular for women, just because of lifespans, often we outlive our spouses. And so one of the things I like about these annuities is the ability to know that you can tap into a tax-free income stream to help cover the cost of assisted living or in-home care, right? And you don't have to worry about it. It sort of gives you peace of mind, but yet, unlike long-term care policies before where you paid premium, but if you didn't use it, the money just disappeared. The beauty of the long-term care annuity is if you never tap into it or you don't use it all, your family there's a beneficiary designation to it and your family can inherit it. So I think this is a really powerful tool. So if you can find these, it warrants consideration. The challenges is they're hard to find. And usually the minimums start with a single payment of at least $75,000. So they're not accessible for the average American. But if I had to design, what you should really have out there in the annuity world is, I think most people should have long-term care like instruments like this to help them, because I don't know anyone my age who isn't dealing with parents and aging and then having that reflection on themselves of how am I going to pay for myself when I get to that point. And I don't know, you guys deal with people going through this. What are your thoughts on those types of annuities solving that problem?
I think the opportunity, I have somebody that I work with on those kind of, she calls them the hybrid long-term care policies. And they also can work. I mean, you're right, because I work with a lot of women too, and I know about all the reasons, the longevity issues and the caregiving issues that they face are much different than men face. But the other thing that's nice about some of those policies too is they can also be structured in a way that they're for both the husband and the wife. So if, because a common thing can be, think about the fact that the husband's is likely to go first, she's probably going to take care of him. So the expenses for his care may not be as great And then when she's by herself and now she needs that help, she doesn't have somebody, maybe if she's lucky, she has a child that can help, but she can often be on her own. And so that policy, if the fees weren't used for the husband, it can carry over to her. So it actually gives her a little bit more. So they can help either one. And then if it's not used up, then there is, as you said, there's a beneficiary that can go to that person at the end. So that is something. And I do like the person that I deal with on these, because she's a CPA and she's not just a salesman, and it's a CPA selling insurance. She actually has to sell insurance as a fiduciary, which is a really nice benefit.
Yeah, and I want to make 2 points. Someone asked about taxes before we wrap it up here, but think about the construct of this. So you both just mentioned there are some good annuities, long-term care, great. They're hard to find. Why are they hard to find? Well, in large part, they're hard to find because it's not profitable for the annuity company. Now, there's long-term care has started to, I don't say decline, but it's getting harder and harder to find companies providing long-term care. I know in Massachusetts, and it's state specific, by the way, so my state specifically, Massachusetts, every year there's at least one annuity company that bails out of Massachusetts. They no longer provide long-term care because it's not profitable. It's barely profitable as it is. And because the math just stops working out for them, they just leave. And I don't know how many there are left. Maybe there's like 5 or 6, but there's fewer and fewer each year because it's not profitable. So when you start to see something it's hard to find or it goes away, it's because they're losing money on it, and they're not going to sell something they're losing money on. And those are probably the ones you want, right? That the ones that they're losing money on, it means it's in your favor. But when they're selling them like hotcakes, it means it's probably not in your favor. And I think the challenge that I see with the industry, and then we're going to dip into the taxes, is, and the consumer doesn't realize this, right? So there are financial advisors, there are insurance agents, and then there are people who do both, right? There's financial advisors who sell insurance, right? And I'm not going to disparage large amounts of financial advisors who do this, because everyone's got their opinion, and my opinion is just like everyone else. It's not good or bad; it's just different. But I think it's a good tool. It's a tool in the toolbox for sure. But when you have financial advisors who can do a lot of different things and they choose that tool, that's a good thing, right? Because it does have a use, right? Insurance, annuities, they do have a use. And you could argue whether it should happen more or less, but either way, there's a use case for it. But when you're an insurance salesman, and that's all you do, you have an insurance license, you only sell insurance. It's like going to a Ford dealership and asking about a Honda, right? Like, yeah, the Honda, it's not very good. You should buy this Ford though, right? And that's the same way with life insurance or annuity salesmen. If you're talking to one and they can't provide financial advice outside of that product, you should expect they're going to sell that product. And I think that's part of the problem is people get bamboozled into thinking, well, it's the best thing. And it's not just them. A lot of the agents get bamboozled. I talked to some of them and they're like, oh, this annuity, it's the best thing. Like nothing beats it, this and that. And it sounds like they're brainwashed. I'm like, well, actually, you can do the exact same thing. Like I can do exactly what you're talking about without annuities. They're like, it's not possible. I'm like, it's easy. What do you think the insurance company's doing? They're doing the same thing. Like what I'm doing, they're just putting in a wrapper in a package and adding extra fees on it. I can do the same thing, but it's cheaper. And, we just use options. It's the same thing, right? They're doing the same thing. They just add a lot of extra fees. So you don't need annuities for a lot of this stuff. Is it beneficial for some people? Absolutely, right? If I wanted a guaranteed floor of income, Social Security plus a pension, it does that wonderfully if you get the right one. But if you're trying to turn insurance into an investment, insurance is not an investment. It's not. They're two separate things. If you want insurance, buy insurance. If you want investment, buy investment. Don't buy the hybrid because the hybrid stinks, right? And so that's how I look at it. But Megan, let's talk about taxes before we wrap it up here, because I know people get confused about taxes, and sometimes, especially heirs of an estate, kind of tend to get sideswiped sometimes as well. So let's talk about the taxes of the annuity.
Yeah, I mean, it basically, they're taxable. That's the long and short of it. So,
How are they taxed?
At ordinary income tax rates.
Okay.
So that's the biggest challenge. And Phil, do you want to jump in here?
Yeah, I'd like to add in another, because I have a client that had this happen. So I go back to college when I was studying taxes, and my tax professor, he said that the tax law, it loves the dead and it hates married people. And the reason he said that was because think about the marriage penalty, right? At some income level, a couple can be taxed at higher rates than you were if you both were individuals. And the reason he said it loves the dead is because there's a step up in basis. We always think about that. You inherit stock in a taxable account, it gets stepped up to fair market value at the date of death. But that doesn't happen if you have an annuity. I have a client that has an annuity that he got from his mother when she passed. It dates back to 1986. It's a regular annuity, and we are pulling money out of it on an annual basis since we started working together, based upon their the couple's tax situation. Figuring out what bracket they want to be in and all that, because they didn't get a step up on that annuity. It still sits back at the old basis, so that when they get distributions from it, not only they tax at ordinary rates, but they never got that step up. So that's another thing. You're right. The general premise is that it's taxed at ordinary tax rates, which is less advantageous than capital gains rates. But it also extends to the fact that if you inherit an annuity, there's no basis step up.
Yeah, it's funny. It happened to me. Inherited a small annuity and realized I had to pay taxes on his income. Like, well, that's no fun. It's funny because when you have an annuity and you're alive, it's like, oh, well, here's how it works. But as soon as you die, like, I mean, all the heirs, I mean, they basically get screwed. I mean, let's say the annuity works. Let's say you're the rare occasion that the annuity works and it grows from 10,000 to 100,000. And you're like, great, I got to step up. Like, no, you got to pay tax on ordinary income on 90,000. Like, oh, wasn't expecting that. That's no fun. And now your income tax goes up. So, yeah, I think it's the one part that I've never heard anyone really talk about. I've talked to a lot of people who sell annuities and insurance and wholesalers and the whole industry, and they don't really talk about that. And it's funny. I always wondered, like, with all the dollars they put into lobbying the politicians, like, why wouldn't they get that changed? Like, maybe that's the give back that they give and say, well, you get tax deferred, but in exchange you have to get taxed at a higher rate. So maybe that's the answer. But I would just find it interesting. So Megan, when you kind of wrap it up here, final thoughts from you.
Yeah, I think keep in mind, I think annuities have a great place in certain portfolios. You need to have a reason for them. You need to understand why it's there, and you need to constantly be monitoring them and understand how the person who sold you the annuity gets compensated. So I'm Megan Gorman, and you can find my new book, All the President's Money, out on pre-sale on Amazon.com or at allthepresidentsmoney.com. Kirk, thanks for having me on.
Thanks for coming on, Megan. And Phil, final thoughts from you.
In general, as I said up front, I'm not a big fan of annuities, but just like anything else, there can be a right time and a place for anything. So if you look at the right kind and the situation works for you, they can make sense because they can take some of that volatility and nervousness out of your portfolio. As for me, I work with women experiencing big life transitions, which I know can be stressful. And my job is to help empower women facing new beginnings with the financial knowledge and tools they need to make self-assured decisions. My firm's Apprise Wealth Management. We'd love to get to know you. If you'd like to learn more about us, you can download our free ebook, How to Flourish Through Life's Big Changes, at apprisewealth.com/ebook. And you can also sign up for our blog. Thanks for having me on today, Kirk.
Great. Well, thanks for coming on, Phil. And thank you both again for joining as panelists. That's the show for this week. Thank you again for joining us on Money Tree Investing Podcast. My name's Kirk Chisholm, Wealth Manager of Innovative Advisor Group. We don't just manage your wealth, we make your life better. You can find more about me at innovativewealth.com. And of course, you can find me every week here on this show. You can also check out our show at Money Tree Investing Podcast. On our website, you'll have access to the show notes, resources, and the archive shows. Please remember to subscribe on our YouTube channel for immediate access to the new shows when they're released. When you subscribe to the show, it allows us to get access to some of the top minds of investing in personal finance. While you're here, please leave a comment and question if you want us to address it on the show. Have a great week ahead, and remember, no one will care about your money like you do, so invest in your life.